All right, let's turn to investment strategy, and we're approaching, of course, the end of what has been an unbelievable year all around, and also obviously on equity markets. So what should you be buying and selling heading into 2021? For more, Junbei Liu from Tribeca and Marcus Bogdan from Blackmore Capital take us through it. They both join us live. Welcome to both of you.
Good morning, Andrew. Thank you.
All right, let me first ask you, Junbei, I might start with you then. Are you comfortable where markets are tracking right now as far as equities are concerned?
Oh, look, I'm pretty comfortable, and I'm pretty optimistic in terms of where equity markets tracking for the next year as well. Underlying economic fundamental looks pretty strong, and especially here in Australia, all the leading indicator has pointed to a pretty good economic recovery, combined with lower interest rate and fiscal stimulus. That we do think that 2021 is going to be a good year.
All right, Marcus, your take on where we are right now?
Well, we're very confident about we've entered the earning expansion phase in this cycle. And so we can see very much improving earnings in 2021 and improving dividends. We do think markets have moved very, very aggressively and are starting to price in a lot of that good news. So we'd expect some form of consolidation, which we would think would be a good thing, but then positive as we move further into 2021.
Okay, Marcus, of course, I was just talking about that rotation, of course, that we have seen from growth into value. So are you seeing that continue? And sort of before we get stock specific, any particular sectors that you're liking at the moment?
Yeah, no, we definitely like that play into value and into cyclicals. So the energy sector in particular, and some very good industrial companies are where we've sort of pivoted the portfolio. And then on a contrary aspect, we're looking to buy some more exposure to gold as a counter to any bad news. Okay,
yeah, Junbei. So on that point, then, before we get stock specific, taking a broader look there, where are you seeing the opportunities?
Look, I agree with Marcus, and also that in general that you do see more value coming from the companies that are trading cheaper, and the earnings has been impacted by the coronavirus related lockdown. Now, these companies will deliver higher return. However, don't just throw away the growth companies, because in a low interest rate environment, the company that can deliver structural growth will continue to outperform. Any sell-off does provide good buying opportunity. Run a portfolio with bit of everything, a little bit of value, a little bit of growth, a little bit of dividend. So that's how we see it. And this market next year is going to be a market for stock pickers. Don't focus on the sector-wise blanket buy. It's more about finding the company that will generate that kind of return.
And are you looking to beyond Australia? Obviously, as far as your portfolio is concerned, you're seeing some good opportunity overseas.
Oh, look, I think there's plenty of opportunities everywhere, really, and in any type of market condition, because we are a long-short fund. However, we do think that Australia, in terms of economic fundamental, Australia does look better relative to the other OECD country. One is we're recovering better from the virus, and economic activity is strong and stimulus is strong. So on these bases, I think Australia would do better, especially if dividend will return from the banks. We actually look pretty healthy.
Yeah, Marcus, do you agree?
Yeah, no, I do like that theme of having different drivers in the portfolio, and certainly returning to some of the growth names if there is a pullback. I think the key thing that we're looking at in the shorter term is this play on the recovery of the Australian economy. We think it's going to be strong, and that's where the emphasis is, and that's where I've sort of pivoted in terms of buy. And on the other side of that is that obviously as risk is coming on, we're expecting better global growth next year. We're seeing the $A strengthen as a commodity play, and so we're less optimistic in the short term around offshore earners, and have a preference for domestic earners at this point.
Okay, so let's get to it. Your buy and sell recommendations. Now, Marcus, obviously healthcare has been in focus for various reasons over the course of the past year. Tell us what you're liking.
Okay, so I'm picking Helios. It's one of the few value plays in the healthcare sector, and it's an earnings and operational turnaround. You've had to, as an investor, you've had to be patient with this stock, but I think there's real catalysts there now that they're achieving. In particular, they sold their medical centres for nearly $500 million. That has de-geared the balance sheet. Net debt to EBITDA was nearly as high as 3 times. That will be below 1 times. That has led to a capital buyback of 10% of their capital, and also a much more balanced and sustained dividend policy. But we're actually seeing a very good turnaround in pathology, imaging, IVF and day hospitals. The base levels of those businesses are improving, and obviously Helios, as the second largest pathology company, continues still to do well with COVID testing 7 to 10,000 patients a day, and we think that will continue for the foreseeable future as well. So valuation perspective, it's on about 10 times EV to EBITDA, which is cheap for the healthcare sector, and we think that they can grow their earnings per share by 8 to 10% over the next 3 years.
All right, Junbei, to you. Here's your opportunity then. Now, look, obviously the global online marketplace has been, there's significant growth over the course of the pandemic for various reasons. What stock are you liking in that space?
Of course, I don't get an opportunity to talk about Helios.
Oh, no, no, please. Sorry, I didn't know whether you're prepared or not, but go, yes.
Oh, I just want to put my 20 cents worth. Look, I think Helios, I don't disagree. I think, it does look very cheap, and the company has done well selling its medical center business. However, I think, the one thing about Helios is that historically they have had issues about achieving their cost targets. So right now a lot of margin uplift and everything is based upon them achieving those targets. If they can achieve it, it's incredibly cheap. And another thing sort of at the moment sort of going against this company a little bit is it's done very well out of pathology because of the COVID related testing. Things are going so well on that front. You look at Sonic, I think every month is achieving record months. So come next year, when we don't have that kind of testing, things might become a little bit tougher to cycle. But look, this is short-term disruption. But for me, I'm much rather to be in the likes of Ramsay because it is a true reopening stock. The earnings evaporated when they had to, stop all the elective surgery. And now we're seeing the sort of when things are opening up, there's a huge waiting list to get back into the hospital. So I think that one is a better play for me. Premium hospital assets and then the earning for the next couple of years will look pretty strong.
All right, I like it. You're both coming from slightly different directions, but you're giving investors something to think about. That's good. Okay, so Junbei, to your buy, what is it?
All right, so I know I talked about many, but I thought I'll pick a little exciting one, which is Redbubble. This is one company we have followed for quite some time, but more recently during the rotation and sell-off of growth company, this one has started to present value. It is an online market space, a little bit similar to Etsy, and however trading at much cheaper multiple compared to Etsy. Quite a big part of the earning come from the US. So it is quite fair comparison when you compare that one with Etsy. The company is actually very generate real earnings, so cash flow positive, and generate a very high margin as well. The company has done very well during the COVID period, and it was doing quite well beforehand as well. Our view is that the November and December is going to be a very big month for this business because that's the seasonality works, how seasonality work, and we think the company would deliver very strong guidance. So it is cheaper than other online marketplace, even compared to the domestic ones, and it has got really high margin returns, and then we see the growth continuing for this business. So we like this one.
All right, Marcus, I don't know if you've had the chance to run the rule over a Redbubble.
Yeah, I think they're absolutely in the right space, and they have definitely executed well. And also, I do like Ramsay Healthcare, and we do have that in the portfolio as well as a broader thematic.
Right, okay.
That's it. That's a tick. That's going to the portfolio.
Yeah.
All right, Marcus, let's get to one that perhaps you're looking to offload at this point. Brambles, why is that?
Sure. Look, this is the other side of the coin. It's an offshore earner. About 85% of their EBITDA is earned in the Northern Hemisphere. Now, we like fundamentally this company over the medium term. It's an industry leader in consumer staples. However, the markets that they're facing into are going through a particularly difficult time with lockdown. Their beverage business, their on-premise beverage business, Kegstar, will be impacted. What we're seeing with the lockdowns in both Europe and in the US. And we think that in the short term that there's going to be sort of more headwinds on earnings and more headwinds on costs. So fundamentally, we like it, but the short term is we're definitely pivoting more to domestic Australia, and we're looking to take some profits in those offshore earners at this point in time.
Okay, Junbei, thoughts? Significant headwinds there. Is that a problem?
Oh, absolutely. Look, I agree. I think it's a sell. The company had structural issues anyway before this COVID-related impact, and though they're buying back their shares, and that is supporting the share price, it's just very hard to see it outperform the market in the next 12 months. Okay,
now Junbei, the home renovation market's just been huge through the course of the pandemic. You perhaps thinking there's the growth is going to come off there, because just as far as your sell recommendation is concerned?
Yeah, look, I still think the underlying conditions very, very strong here in Australia and the US. So, and I think that fundamental is not going to change. But the question is, I think previously Mark has talked to as well, is that how far that some of those stocks have rallied. So you just need to be mindful, what are you paying? One of the stock we're looking at is, it's a good company, it's been well run, which is Reece. We just felt it has rallied very hard, and it's perhaps time to take profit. You know, the company is trading on 38 times next year's earnings, and you know, normally trades about 20. The reason it performed well also is because of the index inclusion.
Marcus, what are your thoughts?
Well, I agree. In a relative sense, I think they've run very hard, and a lot of it's already in the price. I guess it's partly through the execution of their US business, which has been absolutely critical. But when you look at Reece, you look at James Hardie, they've done so well because those underlying markets have been particularly strong. So in the short term, I agree with the thesis.
All right, okay, look, plenty for our investors to have a think as we head into Christmas. Just reiterating there, Marcus's buy Helios, his sell Brambles, and Junbei a buy Redbubble, and a sell Reece. Thanks to both of you, Junbei and Marcus, for joining us.
Thank you, Andrew.
Thank you very much. Have a great Christmas. Bye.
You too. Cheers.
Cheers.